So I've decided to just lean into the whole orange thing, and I'll make sure not to shave and then just keep running so I become more and more orange on a daily basis. I hope you enjoy the transformation over the summer, and maybe by the end of the summer, I'll actually be a full-time bull. That said, this morning in the Alpha report, we speculated that market calm would continue, mostly unlocking potential all-time highs for some momentum names like CoreWeave and Tempest, although I was wrong about qubits potentially coming back. Oklo was also on my list of 4, so 75% hit on those that might momentum today, and those that momentum hard. But while I was looking at potential momentum movers, I was also looking at fundamentals because I like to look at those things separately, but sometimes there's overlap. And so while I was looking at CoreWeave, I went down a little bit of an Nvidia and AMD rabbit hole, and it led me to consider my fundamental bear thesis regarding something that seems relatively unrelated. But in this video, you're going to see how there could potentially be a very, very clear link. See, one of the reasons I've been a little bit of a poopy-doopy bear is because since about the summer of last year, we've seen a dramatic acceleration in the already accelerating path of the 27-week unemployed figure. This is old news. We're not going to spend a lot of time on this. I respect your time, so we're going to keep it fast, okay? Basic bottom line is, if you look throughout history, the darn thing basically never goes up unless there's a recession. See, up, recession. This time it started during a recession. Sometimes it starts at the end of a recession. Sometimes it even goes up after the recession, or it peaks after the recession. It sort of starts in the second half of a recession, leading a lot of people to say, well, we're already in a recession, and so this will all get graded in like a really long recession, and the true peak of this unemployed period, long-term unemployed period, will come in the next recession, sort of like this right here, right? This 2019 rise, and then, oh, it's COVID. Or over here, you get a little bit of a rise in 2007, and boom, oh, it's the 2008 financial crisis, right? It's some form of crisis catalyst that ends up leading to some layoffs. And this is typically true with the exception of very brief moments in time where you get these little mountains like 1995 over here. You got a little bit of brief, nothing like this uptrend we have over here, or in 74 or 63. Okay, big deal. So basically, historically, it would make sense if we went back and maybe painted, honestly, 22 on as some sort of longer, extended, rolling recession, culminated by some massive shock at the end. But is there a potential that this time is different? Understanding that the phrase "this time is different" is usually associated with no. That said, is there a potential that this time could be different and there is a different explanation for why long-term unemployment would rise on sort of a structural basis? And the answer to this is yes, there is another reason for this. This morning I was on a walk with Lauren, and we were discussing how it's very likely that when Jack and Max, my 7 and 9-year-old, enter the labor force, they're not going to be able to enter the labor force and sort of work their way up anymore inside of any role that could really be replaced by artificial intelligence. Now, that will be possible likely for a very long period of time, because I think general purpose robotics, doing general purpose service jobs, is going to take an extremely long period of time. But think about it. You need people to bring your food to you. I mean, I know robots can do this, but generally, like the food service at a table at the side of a busy, street where you've got a restaurant, somebody pull your wave runner out for you, a lifeguard, lifeguard augmented with AI. Now there's an idea. Who's got an app for that? Palantir's gonna beat that one. But the point is, construction jobs, right? Anything physical is probably the last frontier where things really get innovated away. But what we thought is what you'd probably end up seeing, and we've talked about this on the channel as well over the last few years, is really a rise in the long-term rate of unemployed, because as people lose their jobs, they just can't get jobs again because they're being replaced by artificial intelligence. And then those replacement jobs just aren't available at other companies because other companies are like, well, yeah, I don't need your skill. You've already been replaced. And this is where we see these articles, like here's one, IBM slashes around 8,000 jobs, primarily from its HR division, thanks to artificial intelligence. This is just a recent piece here, but we get posts like this on almost a daily basis. When I got back, I even saw a cover of an Atlantic story, and I know people like bagging on the mainstream media, and that's fine, but AI is breaking entry-level jobs that Gen Z workers need to launch their careers. LinkedIn executive warns. Yeah, fair, because that's sort of where you sort of gain your experience, and then you could go on and actually be an executive somewhere else. Like, somebody doesn't get a job as a CEO off the street with no experience, but if they've had previous executive level C-suite experience, it's a lot easier for them to get in. Well, how do you get that first set of experience? Well, often you work your way up at a company, but if those opportunities get replaced by AI, somehow you have to either know somebody to get in, or you got to figure something else out, or, and while you're trying to figure something else out, where do you end up? Well, you end up potentially in this figure right here, this longer term unemployed figure. So is it possible that this chart has actually just been rising since the advent of, frankly, GPT? And the answer is yes. In fact, if you pin this over here, it represents roughly the beginning of 2023, when we started seeing the longer term trend of unemployment rise. Now, this is actually really interesting for the bears out there, speaking also to myself when it comes to this unemployment chart, because I see it as a warning, this chart. This is not good. Historically, this is a very bad chart. But again, could this time be different at this data point? Well, yes, because it is possible, and this is kind of weird, but it's definitely possible. It is possible that growth is being driven by not just artificial intelligence, but by the wealthier cohort of spenders or corporations. So wealthy companies, think, Fortune 500, Mag 7, whatever, wealthier sort of 1% individuals, they spend more. And let's say their contribution to GDP is positive 2%. And poorer individuals are spending, on net 1% less towards GDP. Well, so now let's say if GDP is going to be 2%, but you get a 2% boost from all the rich spending, and then a minus 1% drag, you're still at 3%. Or, you could also make the argument that maybe we're only at 1%, minus 1 because of the poor spending in the toilet and delinquencies rising and pain at poorer levels, but then the wealthier cohort adding 2 back in, and oh wow, you're at 2.2%, which is exactly where the Atlanta Fed real GDP estimate is now. So really, AI is kind of the perfect boogeyman explanation for this. So in other words, the rise in the longer term unemployed chart may be a symptom of growth rather than weakness, which would be the exact opposite of what has traditionally been true. Crazy. Something that would otherwise be an indicator of problems could actually just be a symptom of the growth that we're seeing in our economy. Scary for those who are losing their jobs. Scary for bears relying on this indicator, but also kind of good for America broadly. Anyway, speaking of America broadly, then there's also the question of how much damage tariffs are doing. There is this talk right now that if you analyze how much tariff revenue we're making about $255 billion in tariff revenue. The question, though, is how much greater is that from normal, and what kind of damage is that going to cause to the economy? Well, I'm about to give you some examples of exactly what kind of damage that could cause. But first, a message from our sponsor, Lear Capital, on diversifying. It's official. Meet Kevin has finally partnered with a gold company, but not just any gold company, a gold company that's an education first company, which is awesome because you know me, I'm all about perspective and education first. And I call myself the no pressure agent. And that's what Lear is, a no pressure company for buying gold. It's the only company with a 24-hour risk-free purchase guarantee, over 27 years in the business, and over $3 billion in trusted transactions with thousands of 5-star reviews. Now, look, we've already talked market almost daily here. We know every institution seems to be hyping up gold, and it makes sense. Because if we're going to head into a recession, it's not so much the volatility of the recession when it comes to gold prices you want to worry about. It's certainly a safe haven asset. But you know what I think. When that money printer turns on again, you know what people like investing in. And that's why people like diversifying away from paper money and getting into a safe haven asset like gold. So if you're interested in diversifying to gold, check out Lear Capital. Give them a ring or go to their website. You can call 1-800-707-4575 or go to Lear, that's Lear, Kevin.com for your free gold and silver reports, as well as investor kit to learn how easy it is to own gold or silver in your IRA, or just have it delivered to your door and you can do whatever you want with it. Under the mattress, in a safe, or you decide. Anyway, give Lear Capital a shot over at 1-800-707-4575 or learkevin.com. Also, keep this in mind. First-time buyers can get up to a $15,000 bonus in bonus gold with a qualifying purchase. So make sure when you call 1-800-707-4575 or you go to Lear Capital's website, learkevin.com, you ask them about that $15,000 bonus. Make sure to let them know Meet Kevin sent you. Okay, so here's the scoop. Look, previously we collected about $85 billion from tariffs. Now we're collecting on an annual run rate, $255 billion. That could obviously go down if trade shrinks because of that, but let's just say it doesn't, and we collect $174 billion more in tariffs, in tax revenue every single year. Now let's say the damage of that $170 billion in tariffs is twice as impactful. So we are hurting our economy by $340 billion. Okay, that's about 1% of GDP. So once again, if we're growing at 3% and we damage our economy with 1% tariffs, then we're at 2%. Or if we're at 2.2, which is where the Atlanta Fed thinks we are now, then we're at 1.2. Big deal. Still positive. Again, potentially because of the AI factors, but also the fact that, tariffs just aren't that big of a deal at 10 to 18% or whatever. So we'll see. Where they sit now, as long as they don't get substantially worse, could actually be quite solvable and investable. Maybe. Which that then begs the question of, all right then, are Nvidia and AMD a screaming deal right now? And could one of these double, or potentially both of them? And that's actually an important segment in what we've got to talk about here, because yes, while I'm a big fan of diversifying away from artificial intelligence, if you want to invest in artificial intelligence, these might be some opportunities. So we'll talk about the numbers on these. And when I talk about diversifying away from AI, you got to think, what kind of jobs are still going to maintain? Well, we talked about this, physical labor style service jobs, at least until robots take over the world. And I also think real estate and development, fixing up the fixer-upper. We use AI to find deals, but like actually fixing it up, hiring people, contractors, coordinating work, and then of course, actually developing properties from scratch. All of these things matter. They're things that we have to work with. So this leaves me with an analysis on Nvidia and AMD to consider. So Nvidia and AMD recently have been selling for, in my opinion, below where they should be selling for. There are probably some reasons for that. I think there is fear in Wall Street that their growth rates are going to be revised down and that the stocks are already discounting a lot of the value of these revisions down, either because of tariffs or China or, a slowdown in AI or whatever. But what we really have to understand when it comes to these companies is where they're valued now. For options purposes, their volatility is super low right now, but when it comes to their valuations, I like to use a PEG ratio based analysis. Now, some people use this in a very different way, so I'm going to explain the way I do it versus what other people do. Other people will say, well, Kevin, Nvidia has a PEG ratio of under 1 right now, which suggests it's a screaming buy. Okay, but does it? Well, let's analyze it. Well, if you take Nvidia's price, $135, divide their earnings per share for January 2026 into it. I don't like using the trailing 12 months. Divide that in, what do you get? 30.9. Okay, what is their next 4 years of growth expected to be? 15.9. So PE ratio, 30.9, divided by 15.9, what do you get? 1.94. That's the PEG ratio that I think Nvidia sits at now. Now, I personally think their growth rate will be closer to maybe 12 or 10% over the next 4 years, but that's fine. If you compare them, obviously, to the growth rate that's already happened in the past, which Wall Street doesn't care about, then yes, you will get a PEG ratio under 1. So I always like to use a consistent PEG ratio, look at the end of the year's earnings per share ahead of us, and then 4 years of growth thereafter. That's how I get my PEG ratio. So in my opinion, for a service business at a 269, sort of a justifiable PEG ratio, Nvidia could be a $185 company, and AMD could be a $254 well, sorry, let me make sure I said that correctly. Nvidia could be a $185 stock. Okay, not talking about the market cap or whatever. The stock price could be $185, and AMD could be $254 because their PEG ratio is only 1.21. And I think both of them belong somewhere around 2.69 because that's generally where I price software companies. And when I do my PEG ratios like this, I'm able to consistently compare across different industries and various different companies. For example, when I look at Tesla, I think that Tesla is a little bit pricey right now, mostly because if I look at Tesla, first of all, they're a manufacturer, like they actually manufacture their own products, whereas Nvidia and AMD do not. You know, AMD, for example, doubling down on UA-Link in their consortium partnership with Dell and others to compete against NVIDIA's InfiniBand. These are not products they're manufacturing. They're designing them into the infrastructure for these companies, for the data centers mostly. And there's all this fear about walled gardens, like, oh, NVIDIA's going to walled garden us like Apple, so we need to diversify our technology, whatever. It just bodes well for AMD, but I think the whole industry grows and people are going to take what they can get for a meaningful time in the future until AI hits a wall. But look at Tesla, for example. It closed today at 360. It's actually impressive that it broke out over the 347 level. And the earnings per share that are projected for Tesla, they're actually pretty darn good right now because earnings are expected to be so bad this year at just 193. So take 360 divided by 1.93 for the year. Tesla's technically right now trading for a 186 PE ratio. But Wall Street broadly thinks they're going to return to substantial growth next year at 50% growth, 32% growth, 33% growth, and 49.7% growth. These are some of the highest expectations that I've seen for Tesla's growth in a very long period of time. This has always averaged like 28 to 32%. And now if I divide this by 4, I get 41% growth. That's a lot. The problem is I have to now divide it by the price, right? The PE ratio. So 186 divided by 41. This sucker's trading for a 4.5 PEG. That's insane. So if I do 41 times growth and I take 193 on EPS and I do a 167 PEG ratio, we should be at about $1.32, so $132 per share on a simply auto manufacturer and energy business EPS POV, including EPS growth rates in the future. So already including the next 4 years of growth rates assumed by Wall Street in earnings per share, which does discount some earnings for Optimus, robotaxis, semi-trucks, and all of that. So in other words, it's extremely expensive. And when I compare the three companies, this is a tool that I like doing. Now, don't get me wrong. I still like Tesla. I still like my Cybertruck. I just think the valuation is a little kooky right now and full of a little bit of hopium, which is great because it makes people a lot of money. And I think it's a great opportunity to sort of diversify or set some trailing stops, right? Like milk it while it's going up and then stop out 20% on your way out so you build up some cash. Like, what's wrong with that? So anyway, that said, Nvidia obviously has earnings tomorrow. Bottom line of that is that sort of lets me adjust what I think things are worth. But if we look at Nvidia's earnings tomorrow, we're expecting earnings per share of 0.87 per share. So call it 88 cents of adjusted EPS. Non-adjusted, we're at about 79 cents. Revenue, 43.3 billion. Net income of 21.6. Nvidia typically beats. We're talking 7 out of 8 to 8 out of 8 times. So basically always, they always beat. It's just a matter of how much and then what they say about Blackwell. I mean, honestly, Nvidia's been on a little bit of a downtrend for a while. Maybe these earnings will finally be the earnings that let them break out. And if they break out, they'll break out to 164. Take a look at this. Look at this ceiling you've got right here. Reject. Basically, this downtrend kind of continues. You could draw this probably a little bit more cleanly, but whatever. You get the idea here. This is sort of the channel. That's what I drew, is this sort of channel that you're in right here. And I think you could break out of this and get to 164, which is, that's a fib extension. So, yeah, that could be very interesting for NVIDIA. 164 could be a reasonable target afterwards. Unless they have some kind of like bearish topic regarding growth or whatever, but I don't know. I guess maybe I'm just not seeing that bearishness. I do see competition from, AMD. And you can directly see that competition because some data centers are now concerned that Nvidia is going to sort of walled garden them in like Apple does. That's actually led to a rise in AMD's UA Link. This is a consortium by like Dell and AMD and others to basically compete with Nvidia's InfiniBand, basically wiring your data center with Nvidia components and switches and everything. So like everything is married together and really happy, and it's all the same product, the same company. It's all unified, kind of like Ubiquity. Well, there have been some walled garden concerns, and that's what's given AMD a little bit of a rise here. And so, AMD's been ramping up their MI350. That's going to be especially important here now because of all the Chinese complaints about, oh no, we're not going to be able to sell some of our Chinese products to China. Yeah, whatever. They'll be fine. So I think right now the only thing that's kind of keeping AMD and Nvidia stock growth down, like how much they're returning year to date, is fear that their growth will be revised down. I think the stocks are kind of already discounting that off of the pegs. Because, I don't think I said it, but, at 169, justifiable for Nvidia, you're at like 185. Current Wall Street estimates, right? Mine a little lower. 269 for AMD, you could be a $254 company or stock, right? So, that's a double. That's nice. So, it's looking good. I think some of the China tariff fears have already been priced in. So, basically, you have these two massive price or cash cows. The fears about discounted growth and tariffs, I think, are kind of already built into the stock. And I mean, it would really have to take hitting like a wall or something to get, in my opinion, these stocks to just perform really poorly over the next few years. But it's possible that they do, should that wall hit. I mean, I guess we'll get a little bit more color tomorrow. But I mean, I'm wearing my Jensen jacket because Jensen is not the guy who's going to tell you bad news. That said, that doesn't mean the stock's going to go up. Last time Nvidia had earnings was February 26th, and the stock went straight down right after that. Now, in fairness, that was also in the lead up to Liberation Day, so a lot of things went down over that period of time. We were in a little bit of a bearish downtrend, so who knows? Anyway, that's what I got for y'all today. Thanks so much for watching. We'll see you in the next one. Goodbye, good luck.